The S&P 500 was boosted yesterday by gains in tech, but our guest says that fears over how AI could disrupt entire industries and upend long-standing business models has the market bouncing from one sector to another. This past week, he says, wealth services, real estate firms, insurance brokers, and trucking were all the latest victims of what he calls the AI wrecking ball. We're joined by Craig Basinger, Chief Market Strategist at Purpose Investments. Thanks very much for joining us.
Thanks for having me.
I love that. A wrecking ball. I think it was a Miley Cyrus song. But you reckon that AI, of course, we don't know, obviously, what impact it'll have, but across industries, we're seeing these fears spread?
Yeah, from our perspective, we do think it's an overreaction in the short term. And, there's no question that AI productivity gains, especially when it comes to coding, is pretty incredible. But trying to extrapolate like those kind of gains into all these other industries, I think is a bit more challenging. But the narrative has taken hold in this market, and as soon as any headline comes out that AI is going to have an influence on any given industry, the market's just running out and selling down the names, questioning the longevity of their business models.
You supply an interesting example here. The trucking industry, a Florida company called Algorithm Holdings, said its service has improved freight volumes radically for its clients. And you say that contributed to a sell-off in trucking stocks?
Yeah, and this company, listen, I mean, maybe they're doing some great things, so I'm not going to dig that deep into it, but it wasn't that long ago that they were selling karaoke machines, and even in the more recent quarters, their revenue was pretty minimal. I think it just sort of highlights that, and maybe they do have something great, but I think what it does is it highlights just how sensitive this market's become, and that's really kind of been one of the themes this year. Like if you the markets are fine. If you look at the S&P, it's pretty close to its all-time high. Same with TSX, but the gyrations under the hood have just become, I would say, a bit unnerving. Whether it's AI, whether it's gold going up 1,000, down 1,000, like we're just seeing some really material moves that I think is sort of characteristic of a market that is probably more fragile than it appears on the headline number.
The market is the broad market is more fragile, you mean?
Yeah, and just investor sentiment. Selling off $70 billion worth of trucking stocks because AI is going to help. It just seems like a dramatic overreaction. And I don't. I think the productivity gains and the use cases on the AI side are phenomenal. We're using it quite a bit, but I would also say the market, historically, markets very much overreact in the short term and underreact in the really, really long term. And I think right now we're probably in a bit of that overreaction on the short term tenor.
Insurance brokers, I guess, yeah, if I'm shopping for a policy, AI might make it easier to compare what's out there. I wouldn't want to trust it, absolutely, but it could give me some useful leads.
Yeah, but like there's already websites that do that. So it is interesting how people are sort of like extrapolating that, I'm not going to need a real estate agent anymore, or somehow trucking is going to, solve all the logistics problems, which, let me tell you, I mean, they've been using machine learning and other AI type tools in trucking forever to try and sort of better optimize routes and loads. So I just think it's sort of the mentality of the market, and people are rushing around, and I think a lot of fast money's rushing around to either short or exit and that type of thing. And I think that's creating some of these pockets of volatility.
Right. We're showing Mullen Group, not necessarily caught up in the selling because of this algorithm name, but it's an example of a prominent Canadian trucking stock. Real estate, what is the fear there about disruption from AI?
Well, that's like everybody's just sort of guessing what it could actually mean. But on the real estate side, it's quickly that, is it going to help me actually find a house and close deals and do paperwork and take care of all of that, which normally you would sort of pay a pretty hefty fee to somebody else to do. I think a better trucking example would be Transforce. Mullen's a good trucking company, but certainly more focused on the energy space. So might be some other factors at play there. But yeah, and listen, I mean, Shopify keeps, oscillating in these huge moves up and down, and people are just, fearful that are people going to online shop differently going forward? And so I guess what I'm getting at is this market's overreacting, I think, for sure in the short term in a lot of these names and possibly creating some opportunities. We actually purchased Transforce a few days ago on the weakness on the trucking side late last week. I think the market's overreacting in certain pockets, and that's possibly creating some opportunities. That being said, I would also caution, on the cautionary side, like we've just had 3 great years in the markets, and don't get me wrong, we could have a fourth. The economy is decent. There's a lot of good things going on right now, but 4 years is getting up there, and so one of our themes, while we do see some pockets of opportunities, a bit more on the international side, a bit little pockets here and there, we certainly have a bit more of a tilt of protect what you got after 3 outsized gains. 3 years of outsized gains.
You still are interested in international developed and emerging markets. Tell us, I know that's a very broad category, but tell us what your thinking is there.
Yeah, we were it's funny. I think everybody's sort of have jumped on this bandwagon now. We had a pretty big overweight, and this is in our multi-asset strategies. We had a pretty big overweight a few years ago, and last year it worked out exceptionally well and helped drive a lot of the relative performance for our strategy. But last year I think it was, you look at international markets and they're always typically cheap, like the valuation discount's pretty big against the US, but it's a bit of apples and oranges. I think what changed last year and what really drove international markets was you had this sort of broadening of earnings growth where previous years, it was just the S&P was growing decently. TSX, Europe, Japan they were growing, but just much lower growth rates. And the earnings growth went more global, and that's essentially what drove a lot of the performance last year. And as we roll into this year, it's pretty positive as well. I mean, the earnings growth is continuing. There's still a pretty good valuation discount. And what we like to say is a lot of these markets are what we're going to call fixer-uppers. Like they're actually starting to turn on a bit more fiscal spending that's market friendly on infrastructure and defense. They're starting to change regulations, especially in Japan, where they're starting to sort of show where things are, they're cracking, or they're trying to discourage cross ownership of companies and be more shareholder friendly. And these have pretty big lasting impacts on valuations and the way the market behaves. And I think those are some of the positives. And I would highlight, Japan's been the star so far this year. I think it's up 13-14% year to date, and certainly leading the way.
Maybe we could put up a 1-year chart for TLT, which is, as you know, an ETF that tracks U.S. bonds, longer-term bonds, or maybe just a one-year chart for the U.S. 10-year bond yield. Investors have been swinging into bonds lately. Is that simply because a lot of money's been coming out of tech and looking for a home?
Recently, really recently, or over the last number of quarters?
No, over the past week or so.
Oh, okay. Yeah. So I think there's a bit of a risk-off appetite where people are putting money into fixed income a little bit more. I wouldn't use the TLT for anything like that. That once you go that far out on bond duration, I think you're just playing with a different kind of almost a different kind of animal at that point. But yeah, there has been a bit of a risk-off appetite, and I think some of it is money coming at attack, money moving into defensives, and this includes bonds, it includes defensive equities, it includes even some of the cyclicals. Like money's just, I think, coming a little bit at attack and going to other places. And I would point out if you break the market down so far this year, it's been cyclicals and defensives that have been leading. That have been moving higher, where tech has been moving lower. That's obviously very different than previous years. And I think it's those defensives and cyclicals that are probably helping the headline number hold it up a fair bit better. But I would also say that's kind of weird. Economically cyclicals and defensives, they don't usually travel together. So the fact that both of them are going up, I think, is just another sign that this market is a little bit squirrely, and there's some things going on underneath the hood that are, should have people at least leaning a little bit more on the defensive side.
And just on that theme, you say the swings in precious metals. I mean, silver went shooting up, then came down, or Bitcoin collapsing by about 50%. You say that points to a jumpy market anyway.
Yeah, I mean, I would say on the Bitcoin side, it's halved, and it's not one of its official halvings.
No.
So this one's price related. I would point out that, I think Bitcoin is still a bit of the tip of the spear on the risk appetite in the marketplace. And so it coming down is also endemic of a market that's just, cooling on risk appetite. I think the sell-off in software. I mean, you can explain other reasons for these kind of drops, but I think that sort of all feeds into it. And then on the gold and silver side, listen, gold, we like gold. We still own bullion. We have reduced a little bit last year, but I would point out that when gold goes up $1,000 in a week and comes back down 1,000 in a day, that's not healthy. I would also point out that, we historically we own gold for sort of what we call crisis alpha. Like if everything starts to break down, gold usually kind of rides to the rescue. I don't think that's what gold is anymore. This is now a momentum trade. Now, that doesn't mean it's going to go down. That means it actually could keep going up. But I think it's detached a fair bit from fundamentals. So I think right now it's certainly delivering alpha from our perspective, but it is no longer a defensive diversifier at this point.
Thank you very much indeed, Craig. Craig Basinger, Chief Market Strategist at Purpose Investments.